we begin our discussion of the era of the Financial Accounting Standards Board, which began in 1973, as I said, on July 1st, 1973. Because the FASB, the Financial Accounting Standards Board, has tried to make tough choices to narrow the areas of difference, it has frequently encountered stiff lobbying from industry on major standards. Just like I said, efforts by the APB to do the same encountered the same resistance, but with a full-time body where the members no longer are employees of CPA firms or partners of CPA firms or employees of companies or even academics who are still professors in universities. All of the FASB members are now full-time employed at very high salaries by the Financial Accounting Standards Board, subject to the oversight of the Financial Accounting Foundation. And of course, everything there is subject to the higher oversight of the Securities and Exchange Commission. Now we begin looking at some of the controversies that came up. The first one that I'll mention is not number B, but is not indicated in the slides. In 1973 already, it became evident that the 70s were going to be an inflationary decade. And it turned out that it was an inflationary decade. As a result, interest rates began to rise. As expected, inflation began to rise. And in 1973-74, some companies with a good deal of interest incurred on long-term debt decided, instead of expensing their interest, to capitalize their interest by debiting the property, plant, and equipment for the interest incurred, which meant that the interest would find its way to the income statement as a part of depreciation in future years. They thought, well, since public utility companies had been doing this for decades, a common practice in the public utility field is to capitalize interest costs. They thought there's nothing that says that we who are not in the public utility industry couldn't do it. And of course, it would relieve our income statements of a very large expense that seems to be going up and increase our earnings at a time of low earnings. Well, when these filings got to the SEC, they said, what is this? By what authority are companies capitalizing interest cost? They should be expensing it. There is nothing that justifies their doing it, but of course there's nothing that says you can't do it. GAAP had never taken it up before. So in 1974, the SEC announced that there will be a moratorium on any other companies deciding to capitalize interest cost. Everybody will have to wait until the FASB makes a decision on what is proper practice in this area. And so the SEC referred the question to the FASB. Here it looks like the two bodies are becoming collaborators and not so much in conflict as earlier had been the case. It was not on the agenda of the FASB, but very quickly put it on the agenda. It took some time. And finally, by 1979, in a 4-3 vote, it was decided by the FASB that interest cost could be capitalized for a limited set of opportunities, mainly self-constructed assets. A company builds its own depreciable assets and issues long-term debt. The interest cost could be capitalized up to the amount of the actual interest incurred, and in a few other cases as well. And so since that time, it has been possible in U.S. GAAP to capitalize interest cost in these circumstances. And here was a case where the SEC looked to the FASB for leadership. The FASB issued its opinion in 1979, though by the narrowest of majorities. And the SEC said, fine, that is accepted practice. Interesting example of the two bodies working together. Then there was another problem, a much more difficult one. In around 1973, 1974, it became evident to many that the city of New York was on the verge of bankruptcy. It was unable to service its long-term debt. The paper or debt of New York City was in the hands of all the major banks and many other banks around the country. And there was a serious question as to whether the city of New York would be able to make its payments of interest and principal. And the question was, how should the banks account for this debt, which promptly came to be called, in a kind of euphemism, troubled debt? Well, it was more than trouble. It was almost bad debt, when it looked as if a major debtor would be unable to pay, in this case, the city of New York. Well, this was the first year or two of the FASB, and they began deliberating and began to reach the conclusion, tentative though it may be, that perhaps since the agreements with the banks had been made, that perhaps the banks should show the amount of the debt at a lower amount. Because what had happened is all the banks got together. It was very difficult. The big banks and all the other banks got together and arranged a restructuring of troubled debt with the city of New York. And under that restructuring, it was agreed to postpone the principal payments until the future. Not forgive them, not reduce them, simply postpone the amount until it would be easier for the city of New York actually to have enough cash to make the payments. And this composition or agreement satisfied the banks and satisfied the city of New York, and everybody thought the problem was behind them. Until they got wind that once the APB or the FASB realized this agreement had been made, the carrying value on the books of the banks of the debt from the city of New York certainly had lost a lot of its value, and a loss should be recognized at the fair market value, if there were a fair market value, or perhaps taking the present value of the future cash receipts, now much further into the future, with a higher discount rate because of the riskiness of the debt, finding the present value and writing down the receivable on the books of the banks to a much lower amount, and thus it's something like the market value of that, and therefore a loss would be recognized in the earnings statements or income statements of the banks. The banks were not amused. There was a public hearing in 1976. Walter Wriston, the chief executive officer of Citicorp, Wriston was the most respected banker in the country, and chief executive officers from other major banks who normally wouldn't attend public hearings of the FASB all complained and protested. Wriston stood up and said, if the banks that held the New York City obligations had been required to record an immediate write-off of, say, 25% of principal as a result of restructuring, that restructuring just might not have happened. And he sat down, and it was like a bomb falling, in effect saying that if we had known when we engaged in the discussion leading to the restructuring, that as a result of the restructuring, we would have to write down our receivable to a considerably lower figure and recognize a loss, I just believe we could not have gotten all the banks to agree. And therefore, the restructuring would not have occurred, and the city of New York would probably had to enter bankruptcy, which nobody wanted to see. And all of a sudden, the FASB realized that if it pushed for this solution, it would produce a result that the entire financial industry was opposed to. Not just the city of New York, but all of the major banks and financial institutions as a whole, and probably much of the national administration. Nobody wanted to see the city of New York enter bankruptcy. They were satisfied that the restructuring of troubled debt solved the financial dilemma, and they didn't want accounting to be disruptive. Well, finally, the FASB gave in. 1977, they issued a standard, which I think many have thought, and I thought at the time, was the worst standard the FASB has issued. It said that you would have to recognize a loss as a result of a restructuring so long as the sum of the total cash to be received in the future from the debtor loss would be recognized so long as the sum of the future cash to be received falls below the carrying amount. Well, of course, it had not. The total amounts to be received had not been reduced. They were simply postponed. So the aggregate of future principal payments was well above the amount at which the receivable was carried on the books of the bank. And so long as the aggregate of the amounts to be received was above the carrying value, no loss would be recognized immediately. In effect, they said it would be recognized prospectively, whatever that would mean. It was a way of avoiding running into opposition from the banks and the bank regulatory bodies. And so in this way, the banks, under this pronouncement, did not have to recognize any loss. They continued to carry their receivables at the carrying value already shown, because the sum of the amounts to be received from the City of New York in the future did not fall below the amount at which the receivable was carried. This was a kind of accounting that nobody thought made any sense and was an embarrassment to the FASB and to the accounting profession. And so that was a resolution that occurred to the problem of the City of New York facing bankruptcy. Then, in the inflationary decade of the 1970s, the SEC under Chief Accountant Burton took a very strong position. What was inflation like? Well, 1974, 11%, 75, 9%, 76, 5.7%, 77, 6.5%, 78, 7.6%, 79, 11.3%, 80, 13.5%. It was indeed an inflationary decade. And the question is, what modification should be made of accounting to take into consideration the impact of this inflation on the financial statements? Well, in 1974, the Financial Accounting Standards Board issued an exposure draft calling for supplementary disclosure of general price level accounting, that is, to restate figures for the changing purchasing power of the dollar based on the Consumer Price Index published by the national government. And this is what they recommended in their exposure draft as a supplementary disclosure. The SEC was, of course, going to take a position, and the chief accountant was Sandy Burton. Sandy Burton had been an advocate for current value accounting, an interesting comparison with his predecessors, and he felt current cost accounting, replacement cost accounting, made sense. He thought general price level accounting made no sense because, he argued, the inflation rate has no particular relationship to any particular company. Its own inflation experience is different than that which covers the entire economy. The Consumer Price Index is an economy-wide statistic, and no single company has that kind of inflation experience. Therefore, what makes sense is the changing replacement cost incurred by that company. That reflects that company's experience with changing prices. So therefore, in 1976, under his support, or with his support, the SEC issued an accounting series release, said that some 1,300 publicly traded companies have to disclose in supplementary sections of their financial statements the replacement cost of their merchandise inventory and cost of goods sold, their property, plant, and equipment, and depreciation. all at replacement cost, overturning, in effect, the recommendation as an exposure draft by the FASB of general price level accounting. And the general price level accounting solution was simply dropped, embarrassing the FASB, which wanted to go in one direction, but the SEC, with the support of Sandy Burton, went in a different direction. It was embarrassing. Here, the lead had been taken by the SEC, and the FASB had hoped to take the lead. And so it decided to try to issue a standard of its own. And finally, in 1979, with the support of the SEC, the FASB issued Statement 33, which said that, again, about the same 1,300 very large companies need to disclose in a supplementary fashion not only the replacement cost of those items, the inventory, cost of goods sold, property, plant, and equipment, and depreciation expense, but also the general price level change that would be shown, so that both of them had to be shown. And so this provided a certain amount of recovering of its position of 1974. The SEC was happy with the solution, withdrew its accounting series release, and it was not until the 1980s, when inflation dropped, that in effect Statement 33 was made voluntary and not required. And so here was a case where the SEC rebuffed the FASB by not going down the route of general price level accounting, but instead went down the route of replacement cost accounting, and the two were merged finally in a standard in 1979. So here was another controversy that existed. Finally, as I say, in 1979, the FASB issued a standard combining both price level and replacement cost approaches, should say FASB, for large companies' supplementary disclosures, which was accepted by the SEC. Now we come to another controversy that needs to be discussed involving oil and gas exploration. October 1973, Arab oil states imposed an oil embargo on the United States and said, we are not going to ship any oil to the United States abruptly. And immediately there was an energy crisis in the United States. And in quite a number of states around the country, rationing of gasoline at gasoline stations became common because many gasoline stations didn't have any gas at all. And the ones that did only had a limited amount. And after a while, the gas stations with gas had green flags out in front of them, and the ones that did not had red flags in front of them. And if they had a green flag, there would be a line of cars blocks long waiting to get gas at that one station. And so gas was rationing, and there was a shortage of it. And of course, it was one of the factors that generated inflation during the 1970s as well, because the price of gas at the pump multiplied several times. And the question is, what is going to have to be done as a result of it? Well, there was a problem with respect to the oil and gas exploration companies. One of the concerns raised in Congress is because of the energy crisis, it was important, essential indeed, that the U.S. government develop an energy crisis, an energy strategy, a national energy strategy. But before they could develop a national energy strategy to try to become more energy independent than they were, it was necessary to have an energy database that was consistent across companies. And there was one major obstacle. When oil and gas exploration companies, so many of them headquartered in the state of Texas and nearby, incur the costs of exploration, what do they do with these costs? Well, there were two ways of accounting for it. One way is called successful efforts costing, by which if you drill, say, 20 wells, and one is a gusher and 19 are dry, under successful efforts costing, you capitalize the cost of the one, and you expense the cost of the 19. The other approach is called full costing, That is to say, it's a portfolio decision. If you drill 20 wells and 1 is a gusher and 19 are dry, you capitalize the cost of all 20 and say that is the cost to be matched against the revenue from the 1, treated as a portfolio. The large vertically integrated oil and gas companies, whose names are well known because their names are on the outside of gas stations around the country, had historically adopted successful efforts costing. True, their income from exploration was volatile, but it was swamped by the profits from refining and marketing. The small exploration-oriented oil and gas companies in the southwest of the United States had been using full costing almost totally because they didn't have revenues and profits from refining and marketing. Their revenues and profits came from exploration. And the success ratio that they had every year would change how much expense they would recognize, causing their net income to be highly volatile from year to year if they were to use successful efforts costing. So they preferred full costing. And this meant it was very difficult to compare the net incomes and rates of return of companies in the oil and gas industry because of the different treatment of exploration costs. Congress then passed legislation, the Energy Policy and Conservation Act of 1973, which, among other things, instructed the Securities and Exchange Commission to establish an energy database that was comparable across companies, effectively saying everybody had to use the same method of accounting for oil and gas exploration costs. This was a very hot topic in the oil and gas industry. The small companies did not want to use successful efforts because they were fearful that volatility in their income would drive away lenders and investors in their securities, possibly cause them to go under and become bankrupt. And at the national level, the Justice Department and the Federal Trade Commission were concerned about lessened competition in the oil and gas industry if a lot of small companies went under. So the small companies did not want to use successful efforts costing, and the large companies were totally happy using successful efforts costing. Well, the bill was passed, legislation came through in 1975, and the SEC was authorized to look to the FASB to advise us on how to proceed. The FASB took the matter. It was itself divided at what was proper. There are advocates of full costing and advocates of successful efforts. And finally, just before the SEC had to reach a decision, in late 1977, the FASB issued Statement 19, which said in a 4-3 vote that all companies should use successful efforts costing. The 3 dissented and said they should be allowed to use or should be required to use full costing. Well, this presented the SEC with a problem. They felt it was necessary for them, the SEC, the members of the commission, to conduct hearings to decide for themselves what is the best approach because of the nature of the obligation that was imposed upon them by congressional legislation in 1975. The SEC commissioners, all 5 of them, held many hours of hearings in Washington and Houston and listened to all sorts of interested parties argue for one or the other and dealt with other matters as well. They finally decided, after their hours and something like 10,000 pages of transcript, that neither full costing nor successful efforts costing made any sense. They both dealt with historical costs. They were both arbitrary. They both had advocates and detractors. And so they felt that historical cost was not the solution. And if historical cost is not the solution, neither of these 2 methods is the solution. And the SEC felt, the commission itself felt, current values are what made sense. We heard from a lot of people, they said, in the oil and gas industry, investors, analysts, and others, even people in industry who felt that what investors and readers, other readers of financial statements are interested in are the values of the proven reserves, not the historical costs of the proven reserves. And so therefore, the commission instructed the staff to develop a proposal to use what was called reserve recognition accounting, namely to replace full costing and replace successful efforts costing by recognizing the fair value, the current market value of the proven reserves. Well, this was acceptable to the small companies who didn't like the FASB standard at all and began lobbying the SEC not to accept the FASB's recommendation of successful efforts costing. But when it came to using proven reserves, they weren't concerned. They simply would show the proven reserves. And one of the two methods of historical cost accounting weren't interesting. The parties who were upset by this proposal, which finally was issued in August of '78 by the SEC, reserve recognition accounting, by which the increases in the fair value over the costs actually incurred, that is to say, the amount of the increase in valuation from year to year in the proven reserves would be taken into income, were the highly vertically integrated majors, who were already being criticized for the high profits they were reporting because OPEC was raising the price of crude every quarter, which meant the profits of the oil and gas industry was increasing considerably. And this meant using reserve recognition accounting, the large oil and gas companies would continue to increase their profits, their net incomes, at a time at which people were reviling against the oil and gas industry because it was hard to get gas, and gas was effectively rationed by, as I mentioned earlier, some gas stations having gas, most gas stations not having gas, and the lines going on for blocks. And so the public was furious with the oil and gas industry. Industry was critical of the oil and gas industry for its high profits. And the last thing industry wanted, that is to say the vertically integrated oil and gas companies, was even higher profit as a result of reserve recognition accounting. And they began lobbying the SEC against it. The SEC began thinking about it and realized, well, yes, this is a problem because the estimate of the value of the proven reserves is really so subjective that maybe we don't want to bring these valuations into the body of the financial statements. So finally, in 1981, the SEC issued a release saying, we have revised our position. We still want the valuations to be shown for the proven reserves, but instead in a footnote and not in the body of the statements. And they instructed the SEC to issue a statement indicating how the footnote should be composed, which the SEC did, Statement 69, and many of the analysts of the oil and gas industry found it to be a very informative footnote, but the problem involving the body of the financial statement disappeared, and so therefore the companies that were using full costing continued to use full costing, and the ones that continued to use successful efforts continued to use successful efforts costing, because the FASB reversed itself and said that it would no longer sustain its Statement 19, and companies could go back to doing exactly what they were doing before. Congress got involved in this because when the lobbying occurred, members of Congress were approached, especially by the full costing companies in the Southwest, and Congress began lobbying against the SEC as well. It was a big lobbying exercise, and it was a big controversy between the SEC and the FASB. The SEC wanted to rely on the FASB, but the FASB, made up of people with accounting expertise, were still tied to historical cost accounting. Whereas the members of the commission, none of whom were accountants, really look at it totally differently. They don't come in with the intellectual baggage of historical cost accounting. When they attended the public hearings, they were attending as outsiders of the accounting profession, and to them, current values made sense. But to accountants, historically, it's historical cost accounting that has made sense. So one of the reasons, I think, Why the Commission was willing to argue for current value accounting is because they were not tied intellectually, and you might say emotionally, to historical cost accounting as many accountants were at that time. And then we say in the 1970s and the first half of the 80s, the FASB expended great energy and resources to complete a conceptual framework, which unfortunately accorded recognition and measurement little more than a vacuous discussion. This was a problem. 3,000 pages were issued by the SEC in exposure drafts, in final statements, in discussion papers. There were numerous public hearings. It started in 1973 and ended around the middle 1980s. And there was so much controversy, again, because so many accountants were tied emotionally and intellectually to historical cost accounting, that it was very difficult for the FASB to bring itself to recommend anything other than the current practices that were being used. Historical cost accounting, current values, lower of cost or market, but maybe not higher. And so therefore, when they didn't really come up with any hard recommendations that would suggest any principal changes that might be in the offing for recognition and measurement, it was believed that the conceptual framework did not really move the FASB further ahead in trying to solve particular standards issues by the use of a platform of conceptual thinking, the same kind of problem that faced the Accounting Principles Board in the early 1960s faced the FASB because its conceptual framework did not help all that much. It helped in some respects, in the sense that the FASB did say that they are going to use an asset liability approach as opposed to a revenue expense approach, which said that when revenues and expenses are recognized, they must give rise to valid assets and liabilities to get rid of the illicit liabilities that were created, like, for example, reserve for self-insurance, which was still being used by some companies in the 1970s and 1980s. There could no longer be something like a reserve for self-insurance because it is not a valid liability. And so therefore you could not record a loss or an expense unless it gave rise to a valid liability. And so this was an important change in focus, in emphasis, that there must be a valid asset or liability in the balance sheet, that revenues and expenses cannot be recognized unless they give rise or are related in some way to valid assets and liabilities. It also floated the suggestion of other comprehensive income, which came up as an interesting issue in the 1990s. So it was not without merit in some respects, but it didn't really provide a conceptual framework for helping the FASB resolve some of its most difficult problems. By 1978, the Financial Accounting Foundation, under some pressure from Congress, decided to open the FASB's meeting to the public. They were closed through 1977, but beginning in 78, they were opened, and to greatly diminish the AICPA's control over the FASB organization. So therefore, the AICPA no longer controlled the number of trustees and no longer had as much influence over the FASB. No longer did 4 of the 7 members of the FASB have to be former partners in public accounting firms with public accounting experience. And so therefore the ties with the FASB at the end of the 1970s were significantly loosened, and it was easier to say that the FASB was genuinely a body independent of the accounting profession.